Welcome to this episode of Mo Money. I'm Alexander Palmaris, your host. And this episode, I have Darryl Montgomery with me today from the New York Investing Meetup. And today we're going to ask Darryl for some of his opinions and thoughts that are very insightful on where he believes the market is going to be headed into the future. Darryl?
Thank you, Alexander.
Pleasure to have you with us today. Tell us a little bit about the meetup.
Well, it was started approximately a year ago when I took it over. We meet in the middle of Manhattan. We have about 1,200 members now. It's grown at a very, very fast rate, all by word of mouth. It's very enthusiastic. We basically give the alternative view from Wall Street. We don't sell anything. We present successful independent investors who tell you how they made money in the market. So they have, you will get sort of a realistic perspective of what you can do. And we maintain many, many ways of making money in the market, and you find what you're comfortable with. You hear something you like, you follow it, and that's how you can make money too. You're not likely to do so by listening to official Wall Street pronunciations. Their purpose is to make money for their firms, not to make money for you. And once you realize that, and a lot of people obviously do, they come to our meetings.
So that, I guess, brings us to the next point then. So, with everyone supposedly so happy about this half a basis point drop, saving the economy now and saving us from the housing crisis.
It's in our opinion that the Fed rate cut will eventually be extremely damaging, not only to the economy, the stock market, the bond market, but also the U.S. dollar. That is the important thing that they had to consider, and they did not. The Fed has also made a very clear statement with their rate cut that they are no longer concerned about inflation. And once that happens, you can assume that inflation is going to get very, very out of control. They had lots of warnings of this before this rate cut, and after the rate cut, of course, a number of things happened. Oil was hitting an all-time high both before and after. The U.S. dollar was hitting an all-time low against the euro. Wheat was hitting an all-time high before the rate cut. The dollar, if you look at a chart, and I'm personally a stock chartist, was about to hit an all-time low. And once it actually goes to an all-time low, there is no support on the chart at any point, and we don't know how low it will be going.
But I'm still confused because on TV they're still saying there's really no inflation anywhere. So how is this really materializing?
Well, there was actually two Fed governors actually gave speeches that before the meeting, saying that they thought inflation was under control, even though the official statistics from the second quarter had inflation at 4.2%, and this is hardly a low rate of inflation, and it is quite likely that this underestimates the real rate of inflation considerably. And, you can manipulate statistics, which you should assume that the government is doing. It's much harder to manipulate large markets. And when oil is hitting an all-time high, wheat is hitting an all-time high, and the U.S. dollar is hitting all-time lows, the markets are telling you very clearly there is lots of inflation, and they were likely to have a lot more inflation.
So how do you think people should position themselves for something like that? I mean, should they even care, and take themselves out of their lives and do something different? I mean, is there really anything they can do? What would you suggest that they could maybe do to help themselves?
Well, Alexander, there's a lot they can do. We can, first of all, you have to realize that we are entering an inflationary environment. And once the Fed had made its decision and sent a clear message to the market it does not care about inflation anymore, you have to do what people did in the 1970s when there was a lot of inflation. The things that paid off then were oil, gold particularly, silver. You would want to get your money out of the U.S. dollar. You can buy euros. There are things called exchange-traded funds. You don't actually have to buy the currency itself, or gold itself, or silver itself, which is another possibility. You can simply trade a stock. You can actually look them up, and you should assume that as the dollar goes down, these other things will be going up.
I mean, how does these drops come in? I mean, is this a free market the way the Fed works?
No, it's although people claim we have free markets, the Fed manipulates the markets, and unfortunately under Bernanke, the manipulation has truly got out of control. What you saw in August when there was the first rate cut in the discount rate, that took place 1 hour before futures expired. It actually caused a huge change in the market. And the big banks actually benefited tremendously because they were about to lose a lot of money. And Bernanke reversed that immediately, and they wound up making a lot of money.
Well, that brings up another interesting point also, because, yeah, they were all in so much trouble. And even now, all the earnings coming out from Lehman and Goldman, I mean, they made killer profits. I mean, it almost seems like someone knew something before all this happened. Is that even possible?
Well, it's not only possible, as a cynic, I think it's highly, highly likely. I mean, basically this Fed rate cut is a bailout for the big banks and the investment houses. It is not a bailout for the homeowners. This is not a subprime crisis, even though you will see this on TV over and over again. This is actually a huge, huge credit bubble. And the first part of it that's bursting is the subprime market, which is the weakest part of the credit cycle, or the credit area.
Wow, so this potentially has room to grow much larger.
Yes, this is actually going to grow much, much, much larger. And we're only seeing the very beginning. It is not likely that house foreclosures will peak before 2009. We're only in 2007 right now. We have already hit record high levels, actually, for the last 3 quarters, and we've got approximately 2 more years ahead of us. And New York is not likely to see the maximum foreclosures to 2010.
Right now, they lowered interest rates. We see the Dow again, practically steps away from a new high again. How does this all play in? I mean, it all looks picture perfect. So maybe the Kudlows out there who are saying that there's no real, inflation of the money supply. It's pretty much been constant. I mean, maybe they're right. Is that possible? I go to the store or every time I'm going, just to mail something, or even when going for a slice of pizza at our favorite local pizza parlor. It's more and more expensive.
Many commodities are priced in U.S. dollars. And as the value of the U.S. dollar falls, and as a result of this Fed meeting it's really starting to fall, the price of all of those commodities has to go up.
Well, actually, they don't really matter, though, right? Because for inflation, they're not considered a part.
Well, they do matter. In fact, everything matters. The problem in the United States is we import large numbers of commodities. We import large numbers of manufactured goods. And as your currency becomes weaker, you have to pay more for those imported goods. So, I mean, inflation is basically baked in the cake, so to speak.
So, actually, wouldn't that also mean that all these years when everyone's trying to blame China for a lot of our problems, it would almost seem that actually they were helping us control our inflation by giving us such inexpensive products?
Well, yes, they were helping us control inflation in a couple of ways. First of all, their low labor costs. And they would take the dollars we gave them and buy bonds, which would keep our interest rates down. This entire scenario is likely to fall apart, too, with the dollar declining. And China itself just put on wage and price controls because they have a serious internal inflation problem. And that is likely to backfire, and it actually is likely to cause a lot of inflation in their own country.
So basically, it's all going to kind of cascade out of control and just kind of get worse and worse.
Yes, that's our opinion. And the key to it is that the U.S. dollar is falling. I mean, Bernanke has basically just done what Alan Greenspan did for 20 years, is pump money into the system, pump money into the system. Well, the United States is a net borrower by a considerable amount of money. The government borrows huge amounts of money. We have to borrow a lot of money because we have a trade deficit, because we import many more goods than we export. And consumers have been borrowing far more than their income has been increasing. This borrowing is going to basically disappear because what's happened, investment companies have taken these loans and they securitize them, they put them into bonds, and then they sold those bonds. Well, in July, August, people started to realize some of these bonds are close to worthless. And now most people do not want to buy any more of these bonds. So these credit will have to diminish tremendously. And the United States lives on credit. Our economy can only grow if we keep increasing credit. And since we cannot do this anymore, it's likely that we're going to have a big economic decline.
Well, the Fed could just keep printing more money, though, and then we'll have enough, right?
No, the Fed is, the problem is the Fed has continued to print money, and this is what's going to cause inflation. And we're right at the precipice of inflation getting out of control. And instead of trying to do something to actually dampen it, Bernanke has actually opened the spigots to allow it to simply flood into the country. Okay, the only difference really between Bernanke and Greenspan is Bernanke is doing about twice as much as Greenspan. It's basically Greenspan multiplied. The problem with Greenspan, even though he's like considered a great maestro, his nickname, is that he created two back-to-back bubbles, and actually probably four bubbles during his tenure. And one was the stock market bubble between 1995 and 2000. And to solve the problems that bubble caused, he created a much bigger bubble, which is a credit bubble, between about 2001 and 2007, right about now. Now, the bursting of that credit bubble, which is not just subprime, even though you hear this on TV, subprime is only the first manifestation, the first evidence of the bubble bursting. I mean, this basically includes all credit, includes government credit, includes business credit, you know, all of these leveraged buyouts that were taking place, small business loans, business mortgages, includes residential home mortgages for the consumer, credit cards, which is like, are probably equally bad as mortgage loans, and are also going to become a gigantic problem in the fairly near future, and auto loans, et cetera, et cetera. This is a credit-wide problem. Basically, two things have allowed this to happen. The ceilings on interest rates were removed many years ago, and this has allowed credit cards to go up to 33, I've heard even 39% annual rates. And also the bankruptcy reform done in a couple of years ago made it impossible to declare bankruptcy and get rid of your credit card debt. So this has allowed the big banks and credit card companies to just offer anybody credit cards, saying, well, they're going to have to pay me back anyway, and I can charge them any amount of money I want. And I think they're going to be in for a fairly big surprise pretty soon.
Is there anything else you'd like to kind of close up with, or?
Well, I think people are far too complacent about inflation. We haven't had it since the 1970s. This is a serious problem. The thing you have to watch is the U.S. dollar. It is actually inconceivable to most people that the U.S. dollar could have a sharp decline or a crash. However, it is a realistic possibility now. And you have to basically go back and look and see what people did in the 70s to make money, which is very different from what happened in the 1980s and 1990s.
That's great information, and thank you so much, Darryl, for coming on the show and sharing all this with us today. And thank you very much for joining us, and thank you again, Darryl.
Thank you, Albert. Thank you for having me.